Hello, my name is Joe Hadzima. I'm a senior lecturer at the MIT Sloan School of Management. And this presentation is about company capital structure basis. Now, the first thing that I want to make clear is this is for background education only. This is not legal advice, even though we'll talk about legal concepts. And the reason I caution that it's not legal advice is that legal advice is very fact specific. And I wouldn't want you to take the learnings from here and apply it yourself without having someone who could help you through the fact issues related to that. So with that background, let me tell you what we're going to talk about. First, we're going to look at where do companies get money. And then we're going to say, okay, that money, how is it reflected in the capital structure stack of the company? That is, what instruments will that money either purchase or get? Then we'll talk about equity as compensation, using equity as compensation. We'll talk about a few things related to that. And then finally, I'll talk about convertible debt and safe instruments, which are a way of minimizing upfront costs and trying to bridge things, but we'll get into that a little bit later. So the first point we want to talk about is, where do entrepreneurs get their money? And for that, I found this wonderful little illustrated video from the Kauffman Foundation that lays it out in a very understandable fashion.
Most young companies need money, which may or may not come as a big surprise, but they do. The number one source they get money from is from their own savings, whether it's $200 or even thousands of dollars. That's what we tend to tap first. And a lot of companies don't get money from any other place. They get money from their own savings. And then after that, they're lucky enough to be cash flow positive. They're profitable. So we talk a lot as if all companies require all sorts of external capital. And the reality is that more than half of young companies get all their funding from a combination of founder savings and then cash flow from the business, and we're out of here. Next up on the list is another one that catches, I think, people by surprise, and that's credit cards. Almost every young company you can think of, to one degree or another, was funded on credit cards. And it is the single largest source of capital for young companies after founder savings. And then the next place where they tend to get money is from friends and family. After I've tapped out my credit card and I've used up all my savings, I turn to people I know and say, hey, will you help me? And that's the third biggest source of capital. And then the next place is banks. And the banks are a totally weird situation because with banks, they get a lot of attention, but they actually fund very, very few young companies. But it's not their fault. You have to think about the way bank lending works and how shareholders want banks to lend. They want them to lend money against secured assets. And the young companies don't have any security. They have nothing to secure it against. And the joke in the industry is you can get all the bank funding you wanted to start up as long as you don't need it. And then the last piece is venture capitalists. They get the lion's share of the attention, which in some ways is warranted. You know, your Googles and Apples and FedExes and many others all have venture capital money inside of them. But the reality is, and this is from Kauffman research, less than 20% of the fastest growing companies in the United States took any venture money. And that's not because the VCs wouldn't give it to them. It's because they didn't want it or didn't need it, because they had all those other sources. I don't need money, and I certainly don't need money on these terms. Because venture capitalists, unlike banks, they don't lend against secured assets. They give you money in exchange for shares. So they take some of your company away. So my answer is if you don't need it, definitely don't get it. There's no question the venture industry has become staid. The irony is it's intended to fund disruption, and yet it's an industry that has become complacent. And interestingly, over the last 5 or 6 years, we've seen the emergence of other mechanisms for funding, like AngelList, like these kinds of peer-to-peer funding sources, as people increasingly provide capital in smaller amounts, but more people doing it directly. Having said all of that, though, venture capitalists are hugely important for those young companies that don't have access to bank money, but are growth companies. They have the prospect of being a $5 million or $10 million company in a couple of years, and they need that growth capital to get there quickly. So it's a race. And the way you play the race is by getting money from people like venture capitalists who give you the money so you can compete with other people who are racing as fast as you are. If you can run a company off cash flow and some combination of credit card, your own savings, and friends and family, Bob's your uncle. Run. Keep all the equity, because there's no better thing than being in full control of your own destiny.
So that's a summary of where companies get their money. You can see the range of things there, and not that you have to go raise money in every instance. Let's look at the capital structure stack, by which I mean the legal instruments and rights that various holders of instruments have in your company. Think of it as a stack. At the top, secured debt is the most secure. That is, it's something somebody has lent you money and has secured it by one or more assets of your company. If, in fact, that debt has to be collected, the secured party has a right to go first against, an exclusive right, usually, to go first against those assets to the extent of his or her debt. And then to the extent there isn't enough value in the assets to cover the debt, they become the next party in the stack, which is unsecured. Unsecured debt is everything from trade credit, when you buy something from a vendor, to it could be various loans that are not secured, general debt of the company. Below that in the stack is subordinated debt. Now, subordinated debt is actually debt where there's a contract among all of the debt holders, where the subordinated debt holder agrees that it will take after all the other people are paid off, usually after the secured and general unsecured debt. And these instruments were used a lot in the raider takeover era, when it was viewed that subordinated debt looked a lot like equity, and sometimes it was even convertible into equity. Those three general instruments constitute the debt part of the stack. Below that is the equity part. And at the top of the equity part is preferred stock, meaning that the holders of these instruments are entitled to get things before other equity holders. Preferred stock is usually the instrument that venture capital and private equity investors would take in a company. We'll talk more about the attributes of preferred stock in a few minutes. And below that is common stock. And common stock is what's left after everyone else has been paid off. And for a raw startup, this could be worth a penny a share or less. Think of the idea that, the saying that ideas are a dime a dozen. If it's Microsoft and you own common stock and your name is Bill Gates, you're one of the richest guys in the world. So it's what's left over after everyone else gets paid off. Now, within the equity part of the stack, there are instruments that we can also issue. The ones I talked about, preferred stock and common stock, are actually something we own and have certain rights with respect to voting and other things. Warrants are rights to purchase something, usually stock, and these can be traded in the public markets if they are public stock warrants. Options in the context of this presentation are like warrants, but we think about them in terms of compensation as opposed to using warrants to raise capital. A warrant sometimes, for example, might be given to a bank. Silicon Valley Bank often would take warrants in addition to lending money. And then convertible, the instruments can be convertible. So a typical venture capital instrument is convertible preferred stock. And we'll talk a little bit about what that means in a moment. Now, when we think about debt, it's borrowed money. You're renting money from somebody. It can come from private individuals, banks, other sources. Vendors extend you credit. Sometimes customers will lend you money or provide you with upfront payments. If those payments are structured correctly, we sometimes call them non-recurring engineering, which is not really debt, but it's payment in advance for work done. Debt has a stipulated rate of interest with little or no upside in itself. That is, you borrow or renting money from somebody for a period of time. Stock, on the other hand, if you look at preferred stock, you can look at specific deal terms in the course materials for nutsandbolts.mit.edu. But as a summary level, it's usually given to venture capitalists and investors. It usually has a liquidation preference, meaning that if the company is sold or wound up, the holders of the preferred stock are paid first their liquidation preference. And if it's convertible into common, which is typically a preferred stock, they may also then get a right to get paid out as a common holder. When you have both a liquidation preference and a convertible feature, it's often called a participating preferred. The preferred stock usually has anti-dilution formulas, which are designed to protect the holder. For example, if I buy stock at $10 a share and my preferred stock, and then a year later you sell stock of a different series to somebody at $5 a share, my conversion rights are not at $10, but are at $5, for example. And there are other formulas there. Usually preferred stockholders have board representation and certain veto and approval rights. The latter two are required in a way by the ERISA, the Employee Retirement Income Security Act, which governs pension funds. And when venture funds raise money from pension funds, then they have to have certain rights in order to comply with ERISA. Common stock, the bottom of the stack, we call it plain vanilla stock, usually given to founders and employees. It has no liquidation preference or usually no convertibility. It's residual value after everybody gets theirs. However, within common stock, there can be different voting rights, non-voting or voting. And as we've seen with some of the unicorn public offerings, the founders of some of the unicorn companies have a class of stock that gives them, say, 10 votes for every share, something that traditionally Wall Street has not liked, but because of the desirability of these unicorns, the perceived desirability, they're able to get those through. Not necessarily a good corporate function, but they're there. And then, as I mentioned, options and warrants are rights to purchase stock at set times for stipulated price. We'll talk a little bit more about the terms of options when we talk about equity compensation. Now, capital structure of a company can change over time, usually does. This chart sort of illustrates that. As a startup, most of the instruments are common stock with maybe a little bit of unsecured debt. After a first round of outside financing, with a venture capital firm that might take preferred stock, you get a piece of the stack that's preferred. Common is diluted. The trick is hopefully the value has increased so that the percentage of the common times the value of the company goes up over time, even if the percentage of the common decreases. Later on, we might have a leveraged buyout situation, LBO. And there, the stack gets very complex with different layers of debt, secured debt, unsecured debt, subordinated debt, etc. And when you get a company like Microsoft, pretty much all common stock with some unsecured debt and secured debt. So the percentage of the stack occupied by these instruments changes over time as the company grows or situations change. Now, one thing it's important to understand is what counts. This is a little bit of technical stuff, but I've seen people get fouled up because of it, so I'm going to take a moment to go over it. Let's say when you incorporate, you state in the charter, called the Certificate of Incorporation in Delaware, for example, the number of shares that the company is authorized to issue. And let's assume these are all common for this purpose. And then we go and we issue 150,000 shares. Usually this would require just a board vote, although there are some tricks to that sometimes. And then let's say some of those 150,000 shares are repurchased by the company for maybe somebody, an employee who leaves. And so we're left with 125,000 issued and outstanding shares. The next line, authorized but not issued, is the fact that we've issued 150,000. We had 300 authorized, so the difference is authorized, not issued. And then we might reserve some of the authorized shares for an option plan, say 50,000. And then we have authorized, not issued, or reserved. And this all sounds very technical, but the question really is that when the company is sold for $150 million and you own one share of stock, how much do you get? What do you look at for that? Well, it's either the 125,000 issued and outstanding shares that get divided up, the money gets divided up over, or it might include the options in the plan. If all the options in the plan had been issued and they are with an acquisition, they usually would be exercised, you might have 175,000. So depending on what you're looking at, you'd either get $1,200 a share or $857 per share. So it's really the issued and outstanding that's a key point. So now I'd like to turn to equity as compensation. And we'll talk about Section 83 Trap, and we'll talk about restricted stocks, options, and investing. So in general, when you're thinking about equity as compensation, one question you have to ask is, does equity motivate? Do people work harder because they have equity? The first company I went to work for was a spinoff of a company in a triple-decker in Cambridge, Massachusetts. And we were on the third floor, and the main company was on the first and second floor. And I was a number 3 employee. And first day at work, mid-morning, after coffee, went down to the little half bath under the front stairs, opened the door, and the walls of this little half bath were papered literally with stock certificates. And I think the message was, if you want to work for wallpaper, stay here, otherwise get back to work. The question is, do employees really understand how equity works? And because if they don't, then giving out equity is not valued necessarily. So let's say you're an employee, you're a potential employee of a company A or company B, and you've got these 2 job offers, same position, same monetary cash compensation. But company A says, we'll give you 5,000 shares, and company B says 10,000. Which one do you take? Well, you don't really know that until you know what the total number of shares are. In fact, these 2 offers are exactly the same, but I can't tell you the number of times people will say, well, company B is the one that you'd want to go work for because you're getting more shares. Which leads to an important tip for you, especially when you're talking to employees. Don't talk in terms of the percentage of the company that you're giving. So for example, let's say we started a company and the founders had 100%, and now we bring in some employees and we say, well, you, one employee, and make it easy, we'll give you 10% of the company. And this is the number of shares. And now we work hard and we go out and we raise some money. Investors come in. Well, investors are going to get some shares. And that is going to dilute the percentage ownership of the founders and the employees. So if the employee thought that he was going to get 10%, now he finds out he gets 7%. Now, 7% hopefully is a lot better than 10% because the value at 7% of the company is greater than the 10% was at the time the company was started. So I'd say talk in terms of number of shares, and you can say that this is a percentage of the company at this point. But we've had people have some misunderstandings on that. Now let's take a moment to talk about, how do founders split equity? And that's a topic we could have a whole presentation on, but I wanted to just touch on some key things to think about as you think about splitting founder and then splitting with employees. The first one is the culture of the company and what's negotiated. Now, if you're working in a labor market where everybody in high tech thinks they should have equity, you're going to have a harder time saying you don't give out equity. But you might. Keenan Systems is an example of a company where the founder kept 100% of the ownership of the company, but he rewarded his employees very handsomely with cash and bonuses. And Keenan System was sold for about $1 billion. And I believe I've heard that Keenan actually gave some additional compensation to people at the time, even though they didn't have stock. So it's really the culture of what's negotiated. When you're looking at both founders and employees, what is the value of the past contributions that have been made by the person? What do we expect the value of the future contributions to be? Over the next 12 months? And when do you join if you're part of the founding team? Or over the next 4 years? What kind of sacrifice and commitments are being made? What's being given up? I had a MIT professor and postdoc go through an exercise of writing down what they thought they were bringing to the table and what they were giving up. And that was helpful in understanding. The professor was giving up his 1 day a week of consulting, which had a fixed rate, because he had a history of that. The postdoc was giving up the possibility of having an academic career, plus the salary he could get if he went to work for a large company. And by putting these down, they began to understand and appreciate the other party's positions on things. The postdoc was going to be totally committed to this. The professor still had the professor job. So those things are important to talk through. Ownership of IP, intellectual property, who's owns this, and what are they going to contribute to the company? And as I mentioned, external market value. And then, a very important thing in any company, especially small companies, because people will find out, is the concept of internal equity. You should assume that everyone will eventually understand who has what percentage of the company. And you have to be prepared to justify that, or at least live with the consequences. Another way of looking at founder equity splitting is something I ran across called slicing pie. An interesting approach, entertaining presenter. I put it here, that you can check it on your own. It basically tries to value the services and the assets that are provided to the company over time, as opposed to at one point in time. There are a number of technical issues in trying to do this. I have personally not seen it fully in action, but I do think it's an interesting way to both think about equity and to think about how you would want to deal with it. Now, switching to the section 183 of the Internal Revenue Code, what I call the A3B Trap. This part of the Internal Revenue Code said if you receive property in connection with providing services, and property here includes in a corporation stock. In other words, if you receive stock in connection with providing services, because you're going to be working partially for equity, you have ordinary income, taxed up to whatever the rate is, 35% or whatever, equal to the difference between the fair market value of the stock that you get minus what you paid. And so let me give you an example. Suppose Michael is a founder of a company and he goes and talks to his brother-in-law, and brother-in-law says, gee, I like the concept. Why don't we set up a company? I'll give you $1 million for 50%. Sounds perhaps good, or whatever you think the percentage should be, but here's the consequences. Michael has received arguably either $500,000 of value, and the only thing in the company once it's set up is going to be $1 million in cash plus intangible rights. He presumably pays zero. He has ordinary income of $500,000, and let's say the tax rate for math simplicity is 40%. So he owes $200,000 in cash for taxes. Yikes. But on the other hand, I could argue that he owns twice that, because if brother-in-law gives $1 million for 50% of the company, why is the other 50% not also worth $1 million? So you can see this is not a very good situation. And it happens more often than you'd think. But let me make it even worse for you. So typically, if you're a brother-in-law, you would want Michael, when you put your $1 million in, you've done everything you said you would do. Oh, you'll be there to help out and everything, but basically you're the money person. And Michael has yet to do everything he said he would do. He's going to be taking the money and he's going to be developing a product or whatever. So brother-in-law might rightly say, well, you can have 50% of the stock, but only if you actually do what you say you're going to do. And so, as we'll talk a little bit later about investing, you want to vest that stock over time, meaning that if you leave, some of that stock you have to give up. And this is called the risk of forfeiture. And under Section 83, if you have a risk of forfeiture, you don't measure the amount of income when the shares are received, that maybe they were a penny a share, but when they vest. And if things are going well, that could be down the road and very expensive. A way out of this is filing an 83B election. This says, hey IRS, I want to take my income hit today, not when the vesting occurs. Now the problem is that has to be filed within 30 days of the date you get the shares. So the scenario that I had routinely seen is somebody would come to me and say, hey, I got this term sheet, and can we set up the company so we can get going? And the question is, well, what happened between Friday when the term sheet arrives and Monday when we start the company that increased the value from a penny a share to you to $1 million when brother-in-law comes in? And it's hard to figure that out unless, maybe the FDA, approves something. So that the way to avoid this trap is to separate in time when the stock is issued to you from the investment by others. So if Michael had incorporated, say, 6 months ago, at a time when ideas are a dime a dozen, and over the next 6 months, he works and does a prototype or whatever, and then along comes brother-in-law 6 months later, so we can have a credible argument that says that the value had increased over that period. And more importantly, if Michael actually had the shares back 6 months ago, that's when he got them. There's no question. Versus later. It's hard to argue when Michael's getting shares at the same time brother-in-law that they're not worth the same. And so the question is, why don't people do this? Well, there are a couple reasons. One, they may be too busy, lots of things going on. More typically is they're not sure who should get what. That is, we haven't really tackled the issue of splitting up the founder stuff. And over the years, I found a diagram helpful to explain some of the dynamics. So let's say we have this chart. Time is horizontal axis. Relative importance is the vertical axis. And let's say we have a technical founder and a business founder, two people. And the technical person at the beginning is going to be relatively important because it's his or her idea. Most likely they need to continue to develop it. They're probably going to be working long hours. The business person may still be working in another job, working in the evenings or weekends to work on the business plan. And so at the beginning, the technical person's relative importance is high relative to the business person. But over time, for a successful company, you're going to see a dynamic that looks like this. The relative importance of technical decreases, the relative importance of business increases. So if we're back at the beginning time and you're the technical person, maybe you feel generous because, it's your idea, you're going to be working long and hard and all of that stuff, but maybe you give up 5% of the company. Well, that makes sense maybe from your perspective at the beginning. Whether you can attract the kind of quality business person is another question. So understanding sort of how that works is important, and having those discussions early on to avoid 83. Now, another way we could avoid 83 is to issue preferred stock, maybe participating in preferred stock to brother-in-law and common to Michael. So let's say brother-in-law gets a preferred stock where he gets the first $1 million of return if the company is sold. And then in a participating preferred, he would have a right to convert and get, say, 50% splitting it 50-50 with Michael afterwards. And the question is then, if we do it this way, what is the value of Michael's common? Well, really, it's an option on the future value of the company to the extent that value increases is above $1 million. So if brother-in-law puts $1 million in on Monday and we decide to close the company down on Friday, having done nothing, the first $1 million goes back out to brother-in-law and Michael gets zero. So it's really, he has nothing unless the value is over $1 million. The question is, what would you pay for that option on the future value of the company with an unlimited duration, it's all into the future as long as possible, with an unlimited upside? If this turns out to be Facebook, it'd be huge. And option pricing theory might say that it's 5 to 10% in this situation in the first round venture kind of deal under these sort of dynamics. 5% is the number that's I see more typically with Silicon Valley companies, 10% on the more conservative East Coast thing. Now, there are implications of issuing a preferred in connection with qualification for Subchapter S tax, which is a topic beyond this presentation, but Sub S is a way to avoid 2 layers of tax, and it can be very important for startups. Preferred stock would make it impossible to have a Sub S, but we'll talk about Sub S on a later presentation, or maybe you've already heard it in an earlier presentation when we talk about legal forms of doing business. So now I'd like to move on into what common forms of equity compensation there are as we try to use equity as a way of compensating people when we don't have the cash. There are 3 main ways. One is restricted stock. One is incentive stock options, which have certain tax benefits to them. And the other is non-qualified stock options. So restricted stock is stock that's sold or granted outright, usually when the value is low. And the reason is because of Section 83. When you get the stock, it starts the capital gains holding period, and also SEC holding periods for when you might be able to sell under securities laws. And typically, as we mentioned, it's subject to vesting and buyback by the company. So if we can make a timely A3B election, we could get modest or zero income at grant. No further income would be required to be recognized until the stock is sold, and then hopefully it would be capital gains because of the holding period. And no employer tax deduction for the increase in value. When an employer pays you cash salary, the employer is able to deduct that as an expense of business on the income tax. In the case of restricted stock, if the 83B election is made, there would be no further ability to deduct the value that stock might increase to. Typically, restricted stock would be given when the cost to get the stock to the person in terms of tax is manageable. When it becomes more expensive, when the stock value has gone up, we might switch to incentive stock options. These are options that comply with tax requirements, including the fact that there has to be a plan, a written plan. It's only for employees of the corporation, not independent contractors or non-employee advisors. The option would say you have a right to purchase X shares of stock at an exercise price of $Y. And that exercise price has to be the fair market value of the stock on the date of grant. Often then you do get an appraisal to support that. And typically the right to exercise vests over time, just like we talked about before. If you're with the company for a certain period of time, you can exercise. There's no tax or grant, no tax on grant or vesting. There may be a possible alternative minimum tax on the exercise. That's something you should talk to a tax professional about. and there would be tax upon the stock sale. And that tax will be capital gains if you meet two holding period requirements. One is that you wait a year from the date that you exercised the stock and sold it, and you waited at least 2 years from the date that the stock was granted to you. And if you do those, you get capital gains instead of ordinary income. And correspondingly, there's no employer deduction. Non-qualified stock options are basically options that don't meet that requirement. There's relatively complete freedom in design, but there may be some accounting issues. There may be a tax issue. For example, if the stock's worth $100 a share and I give you an option to buy a share at a penny a share, it's almost like I've given it to you outright, and that could trigger a tax thing. But you don't have to go through all of this fair market value type things. There is no tax on grant or vesting, but there is ordinary income and a corresponding employer deduction when you exercise the options. So in this situation, you would typically not exercise an option until there was a reason to, such as the company's going public and you could sell the stock, or the company's being acquired, or a case that I encountered where I had stock on a stock option for a duration of 10 years, and 10 years was coming up, and the stock had real value. And if I didn't exercise it, I'd have to give up that value. So I sort of swallowed, exercised, and paid a pretty hefty tax at that time. But I made out fine. Because there is an employer deduction, typically think about it. If I pay you a cash salary, I have to take cash out of the bank account and give it to you. In this case, I'm getting a tax deduction, but I haven't had to give you any cash. So sometimes, depending on the situation, for a valuable person, we might have an agreement that the company would give you an additional bonus to help you pay the tax, and that bonus would be in cash, and the employer could get that deduction. So we have sort of talked about vesting, but let's go into it a little more detail. It's conditions on keeping what seems to have been awarded to you is one way to think of it. Back to Michael and brother-in-law. Brother-in-law would like to know that Michael's actually going to do what he said, and performance vesting would be the way to do it. You're going to take this idea and take a product to market. Well, maybe your vesting should be a certain percentage when the prototype is finished, a certain percentage on the first beta ship, and the final percentage on full product introduction. Business-wise, that makes a lot of sense at first, but because companies often pivot when they understand more about the market, that the product is not the one you started out with, and everything, it's very hard to tie performance vesting down at the beginning. And so the fallback is time-based vesting, which says, hey, as long as you're here, Michael, and you're still giving it the good effort, you'll vest as time goes by. Typical vesting is 4 years with what's called a 1-year cliff. That is, if you leave before the first year, you either get 0 shares or you can't exercise anything if it were an option. And after 1 year, 25% you can keep if you leave, or 25% you could exercise. And then typical vesting for tech companies is over the next 3 years. I think the trend is towards monthly vesting. Every month you vest 1/36th more. And then sometimes these plans will have the right of the company to buy back the shares at fair market value when you leave. That's a whole other discussion that we should have about whether that makes sense. And then finally, accelerated vesting on change in control, which would be like an acquisition or an IPO. Some people think, well, if the idea is we're supposed to succeed and we can go public or we're acquired, doesn't that mean we succeeded even though we didn't take 4 years to do it? And so therefore I should have full vesting. And there are issues on both sides of that. The acquirer is going to need to put some compensation on the table to retain people in most cases. And so they're going to take part of that out of the purchase price mentally. which means you're sort of taking money from the non-employee shareholders, is one way to look at it. And the flip side is, well, but if we did such a good job, why shouldn't we get the benefits? So again, a topic to think about. Okay, speaking of topics, we've been through a number of things. I wanted to finish up by talking about convertible debt and safe instruments. So these are very popular, and you've probably heard about them, or you will hear about them. So let's touch them for a moment. So convertible notes say, look, I'll lend you money, and when you use that money to build the product, whatever, and when you raise the first amount of big outside round of financing, I'll convert that debt into that stock. And the arguments for this is it's quick, it's inexpensive relative to drafting up the preferred stock documents. It avoids early stage valuation issues. In other words, let's say you and I agree that the company is worth $5 million, and that's what we put the value on. And later you work hard, or let's say we say it's worth 10 million, and you work hard. A year later, you raise stock, $5 million valuation. Well, that means I'm going to get crammed down in terms of the value of what I have. There are pros and cons of convertible notes at a couple of websites that I point out there, and there is also this instrument called SAFE, Simple Agreement for Future Equity, that came out of a Y Combinator program. Again, you can read up about that, but a key difference there is that convertible debt is actually a legal instrument, a debt instrument, where if the company defaults, the holder of the debt can come in and claim the assets, including the intellectual property. There are also potential issues about whether the interest accrues and is taxable to you, even though you haven't been paid. A SAFE is not a debt instrument. It's simply an agreement to issue stock in the future on similar terms. And some people think that's a better way to go. You can look at some term sheets and actual documents that a few law firms have some good materials, Cooley LLP, Wilson Sonsini, and Goodwin Procter. But we'll look at the key terms now. There are two key terms, the conversion discount. So the idea is, if I give you money that helps you increase the value of the company so that when you raise the outside money, the value is higher, why should I have to pay that increased value? I took the risk earlier on. And so one way to address this is to say, well, I can convert at a discount to whatever the purchase price for the next round is. And the typical range is 15 to 25% discount. A related topic is a valuation cap. Same concept here. Let's say you take my $1 million and the next round values the company at $50 million. And I have to convert my million at a $50 million valuation, even with a 25% discount. I'm paying a lot. So here the idea is that there should be a cap on the value that I will be forced to convert or have an option to convert on. And in other words, if it's a $50 million valuation in the next round, I don't have to pay more than the valuation cap. It's sort of a proxy for valuing the company today, but it's not quite the same. And it's usually an either or in the key terms. So let's take an example. Let's say it's $1 million note, a convertible note. The valuation cap is $7.5 million, and the conversion discount is 15%. And you have to know the fully diluted number of shares. We'll touch on that here. You can read about it in the links that I gave you. We'll call it 1.4 million here. And the Series A, the first outside equity round, comes in at $5 a share. So you do the math. The conversion at discount would be at 85% of $5, or $4.25. The conversion at the valuation cap would be the cap divided by the number of shares. And that, in this case, turns out to be $5.36 a share price. And so you would pick the lower value to convert at, and you would get 235,294 shares. Again, you can read about all this in the links that I provided. So that's sort of our discussion of capital structure basics. We talked about where do companies get money. We looked at the capital structure stack, went into a little bit of the issues around using equity as compensation and the kind of instruments that can be done there and how to avoid the A3B trap. And we touched on convertible debt and safe instruments. This is by no means a complete in-depth discussion of capital structure, including details around preferred stock and financings and all of that, but it hopefully is going to provide you with a good basic understanding of what's there. For more information, there's materials at the nutsandbolts.mit.edu site. And if you have questions, feel free to email me at jgh@mit.edu. I hope you found this informative, and I wish you well on your entrepreneurial journeys.